For the next presentation, the Patricia Berjón, the head of corporate development at Global Dominion, will join via video call. Global Dominion, from our point of view, is one of the most undervalued companies in Europe. We believe that the investment case at the moment is extremely interesting. It is a good company with a very low price and a very good management team. Why is the company so undervalued? We believe that there are two main reasons why the company is undervalued. First, most analysts in the market are perceiving that company as very complex, and I will briefly explain why we believe that the company is a lot simpler than most people believe in the market. And then, if you look at their balance sheet, their consolidated annual accounts, you will see, for instance, at the end of the first half, you see there close to 200 million euros in financial debt, but most of that debt is not linked to the main projects and services division, which is the main business, and then they have some assets in ownership. So that out of 198 million euros in financial debt, close to 125 million euros is linked to the assets in ownership. Regarding the simplicity of the business, Global Dominion has two main core businesses. First, services. So it's sustainable, what they call sustainable services. In terms of sustainable services, it's mostly recurring revenues, so maintenance and maintenance services for different companies. So they get very recurring revenues, is extremely high cash generative. And then, so those, interestingly, so all those projects, they are very similar in nature, so they may have hundreds of projects, but all of them have a margin, a contribution margin of around 12%. And then they have their projects division, they call it 360 projects. All those projects are one-off projects, multi-year projects, and they are also very similar in nature. So they are one-off contracts, and for instance, the engineering and constructions of some like social infrastructure, like hospitals, then some plants, like industrial plants, energy plants, and here the margins are a bit higher, around 15% contribution margins. And interestingly, so with this business, projects and services, we expect an operating profit of around 100 million euros in 2-3 years. The company is worth 400 million euros. In this same, and most of the debt is linked to the assets in ownership. In terms of the assets in ownership, they've announced that they are not going to keep majority stakes in those projects. They're just going to take minority stakes. So as they sell many projects to new investors, they will get cash in, and that debt on the balance sheet will be out of the balance sheet. So we have a company able to generate around 100 million euros with organic growth. The projects and services division has grown organically at a rate of 9% per year for the last 10 years or so, with stable and growing margins. Is not a construction company, so we see that company more in line or more related, it's more similar to other companies in the market, like SPIE in France, or SPIE, for instance, also in the Nordic countries, companies like Bravida, Instalco. So in local markets, the biggest companies, they've been able to maintain higher margins than their local competitors. And Global Dominion is one of the few companies which is global. So Global Dominion is present in 35 countries, and we believe that it will continue growing organically in all those countries that the company is present in. So a company generating 100 million euros, worth 400 million euros with pretty much no debt, growing organically very fast, increasing margins, and they also have stakes in businesses which the accounting book value of the stakes in infrastructures is around 100 million euros, and we believe that's worth more than 150, maybe even closer to 200. So enterprise value EBIT of 4 times or less, We think that the market is not valuing that company properly. It's very good, and also the management team, they're very strong. So they're the main owners are the same main owners of CIA Automotive, which is one of the best companies in Spain. Gestamp, which is also one of the best managed companies. So it's the Rivera's family. We believe they are very smart businessmen in Spain. So we have good company, good management team, and a price that we believe it's very surprising. And Patricia, I very briefly explained the different divisions, and Patricia will explain the outlook for this division. It will take around a minute, as she's going to join us online, and you'll see her shortly.
Okay, so first of all, thank you very much to Tenvalue for hosting us, and it's a pleasure to present Dominion's story to you. As Javier has said, he's probably already give you a big picture of who we are and what we do, but I would like to focus more on our strategic plan and where we are going. First of all, we identified three main transitions that our clients are facing, and we are positioned and we want to be facilitators and partners of our clients to address the challenges that those transitions pose to them. So those they imply many things related to decarbonization, circular economy, energy efficiency, electrification of the economy, and those kind of activities that are the activities that we are strategically positioned will drive our growth, and most importantly, will drive an improvement of our margins. And this is something that we are already seeing in our numbers, because the strategic plan I'm talking about is a strategic plan that goes from 2023 to 2026. So we are in the second years of this plan. So we want to do this for our clients, and we will do it, or we are doing it through our two core segments or main segments of business, which are the sustainable services and the 360 degrees projects. One of the pillars of the strategic plan was this positioning on sustainability, and the second pillar would be the simplification of the company. We are a very diversified company, but we want to reorganize or refocus our structure to address this challenge of sustainability. And we want to be clear that we are a company of projects and services, that we have those stakes in infrastructures, but it's a facilitator or a tool to maximize the profitability of the core businesses. So what you can expect to see during this strategic plan is how we are more and more focused on these projects and services that I'm mentioning. I'm sure Javier has gone through it, but I would like to highlight some things about each of these segments. Sustainable services, it's a segment where we are seeing a high organic growth. It's a segment very recurrent, and we have like a recurrency rate of 85% of the activities. And it's also a segment where we are seeing and we will see improvements in the margins. A lot because of this focused on high value added activities, and also because here you have, I mean, if you are following us, our story, or you start to follow it now, we have already made some divestments of activities that are less profitable, and we are focusing on the ones that are more profitable. So we could expect from this segment that it grows strong organically, but also M&A will come into this segment, some reorganization in form of divestments. It's also a net cash business because it's the two main business segments, both services and projects, are net cash or high levels of cash flow generation. 360 degrees projects is not so much about recurrency, it's more based on backlog. So we have a backlog of more than 2 years, a backlog above 600 million euros. It's a backlog that gives us visibility on the top line, but also we know that the margins in this segment are high nowadays and will be high because of the things that we have already included in our backlog. This segment will mainly grow organically. We are not planning so much M&A or new investments in this area. We have good prospects for it in all of the areas, the social infrastructures, industrial infrastructures, and also the energy ones. Um, Even if it's a project kind of business, it doesn't require capex, and we're seeing very good opportunities here. And last but not least, we have these stakes in infrastructures. As I said, does this wouldn't be a segment in the same sense as the other two ones, but more a way of maximizing the other two. I think the most important thing in the near future um, for infrastructures will come in the form of divestments of the infrastructures, the assets that we have here. We have some debt linked to those assets, and I think those divestments that are close to happen could become catalyst of the story and of the stock. As I know I don't have much time, I wanted to go a little bit through the strategic plan and now highlight some of the key elements that I believe um, are important in Dominion's equity story. First, the first two of them very related to this positioning in growing trends. Also with this unique value proposition of covering the whole value chain and capturing the maximum of the margins of the value chain, positioning us as a high or as a value added partner for the clients. Also, this strategic focus on sustainability is not only as an opportunity, a business opportunity, but also it's a commitment to be a sustainable company. And we have our targets of ESG and we work towards them. I would like also to highlight that we have a strong management team that has been in the company for a long time. Our CEO being also founder and shareholder with more than with almost 6%, with our top 50 directors with the skin in the game as shareholders as well. And also this team leading a company with a very strong culture. And for us, this is something very important because we are a company made out of people. So this would be the five key elements of our culture: digitalization, because we really believe and we really apply technology in everything that we do; diversification, with more than 1,000 clients in 35 countries, so non-dependent on any of those clients or the different sectors we are present at; decentralized management model, which incentivizes very much um, the the different management teams, and we incentivize them based on their cash flow generation. And this leads me to the next one: this financial discipline, very focused on cash flow generation and looking at the lower levels of the P&L, and sustainable development, as I mentioned, both as an opportunity, as a responsibility of a commitment as a company. Apart from this, I would like to highlight the track record of the company. It's a company with high cash flow generation that we have generated since we are a listed company. Story of profitable growth. We have both growth our revenues and our margins at high levels, and it's a mix of organic and inorganic growth, but we pay a lot of attention to organic growth. And it's not that we are staying where we are. We have moved our EBITDA, for example, in the last 8 years since our IPO. We have tripled it from 50 million euros to 150 million euros, but we have ambitious goals for the future. In our current strategic plan, those are the targets for the guidance. Once we have met the 2023 guidance, the guidance for the first year. Now we are in this 2024, 2026 guidance, where we talk about CAGR, CAGR, at the levels of sales more than 5%, that will translate into an EBITDA growth of 7%, and then an operational cash flow generation of 9%. All of these paying attention to the return on net assets that it's been, and we are targeting it to be higher than 20%. And we want to move back towards a net zero debt. We have always been a company in a net cash position for the last couple of years due to this transformation of the company, or this bet for to owning or have some equity in infrastructures to build those core businesses and to maximize them. We have in a transitional period, or something temporary, that we have this financial net debt, which is very important, and is linked to assets. We have it in place, but the plan is that by the end of the plan, this is reduced to a net cash position or net debt zero. And this is what I want to share with you.
No, very good. Anything else that key important? There's limited time, but maybe if there's something else that you wanted to highlight.
No,
we can go for questions.
I wanted to try to meet the time constraints that we have.
Yeah, very good. It's also important because in Spain, when we speak to many professional investors, and Global Dominion is a very well-known company, so you can see that name in the portfolios of some of the best independent asset management companies in Spain. But outside Spain, not many people know about the investment case. So it's a bit about complexity, the perception of complexity, that we strongly believe that is very simple. It's a lot more simple. It's a lot simpler than what many analysts believe, and also we think it's just a matter of time that many people don't understand and don't know about the activities and about the investment case. Do you have any questions about Global Dominion? There are no questions. Yeah, there is one question.
I would have a question. If they're looking at the project, how it's structured? I mean, 35 different countries, quite complex. What is the formula? I mean, do they then do and sign it? So I get the project finished, turnkey based, and the risk is at Dominion, or how do they structure it? With the costs of implementing it, building it, etc., etc.
Patricia, I don't know if you listened. If you could listen, I would also add that.
I couldn't get it very well, but it was related to the risk of the project.
Yes, because you are present in more than 35 countries. So. Yeah. How are those projects structured? If they're like turnkey projects, like the length of the projects, and if you can also link that, because we're aware that you have even higher margins than the main companies in the sector, even the best ones. So first, how are the projects mostly structured, and then why are your margins so good, or why they've been so good historically?
Yeah, they are turnkey projects. We want to be present in as much in the whole value chain, because we want to capture all the margin, and being present in the design phase, and then executing the project, and even staying in the long run, providing the service of operation and maintenance of this infrastructure process is what we want to do. That's why we have higher margins than maybe other competitors, because we are capturing the whole of it with very relation of partnership with the client. So it's usually win-win. We have a wide variety of kind of projects. So in terms of volume, they can go from little ones of 1 million to the biggest ones that could go higher than 50 million euros, even some specific ones, not in parallel, but at some points of 100 million euros, for example. It's very, very important to us to manage the risk. Is where we pay a lot of attention in defining the contracts, in defining the responsibilities and the guarantees that we have in those projects. In terms of length, that I think you mentioned it also, they differ. They could go from 3-6 months to a couple of years. And one other feature of those contracts is that they work with prepayments, and as they work with milestones, we try and we manage to maintain those prepayments almost in the end of the project. So I don't know if I'm answering the question or there was something else.
Yeah, are there any more questions?
Does it work on cost plus or?
Does it work on cost plus or?
Not usually. When we started doing renewables, for example, we started with open books because it was a kind of business that we didn't know very much at that time. But they are usually turnkey projects where we have a defined price and defined scope and timeline, and then we maximize the margin during the execution. But it's usually we have a very good track record in executing projects, and that's the reason we can maintain levels of 18, 19, even 20% in the contribution margin of projects.
Thank you. Thank you, Patricia. Thank you for joining us today, and we stay in touch. And
yeah. Thank you very much. I'm really sorry that I cannot be in person with you, but I hope that next time. Thank you, Javier, and thank you, Tenvalue.